Good afternoon. Happy Wednesday. My name is Stock Darts, and we're going to do what we always do on Wednesdays. We're going to go ahead and take a look at the four major market indices. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Uh, Anyone has a chart request, feel free to add it into the chat. I'd be more than happy to go ahead and take a look at it once we go ahead and cover the markets. If you like what you see here, you can always follow me at Twitter at Stock Darts. You could find me on YouTube under the same name, Stock Darts. Or you could visit patreon.com/StockDarts, where I post weekly blog content including trade ideas, watch list ideas, as well as putting up the reviews of these Wednesday market reviews as well. Other than that, let's go ahead and get started. What we want to do first is go ahead and take a look at the S&P 500. We have a market that is doing pretty well today. So here's a look at the S&P 500 through the ETF SPY. And as we can see, we have a big breakout, pushing to new all-time highs, and are really just, again, starting to continue to rally forward. We have actually been trading pretty consistently upwards since basically the holiday season. And we had a nice little consolidation range in between there, and we've been sort of stair-stepping. And as I mentioned last week, we started a new stair-step recently, and we are now looking like we're going to start pushing past that and continue to keep going on past that. Our market continues to be in a very strong bull market, and underneath the surface, it doesn't quite feel as strong as what we're seeing in the indices, and some of that has to do with just some of the rotation that's going on. But that's part of what happens when a bull market starts to stair step upwards, like it's done over the last 2.5 months now. Is you get rotation back and forth, and that was one of the themes that we discussed last week and the week before that as well. Is how these different areas of the market take turns rallying, while the other areas go ahead and take a break from, and you get a little bit of profit taking and a little bit of consolidation going on in between names. And it looks like as of now, with Netflix reporting earnings yesterday that were pretty well received, it looks like it's the FANG stocks' turn to kind of rally, and that's what we're seeing. You can see if you look over here at the four major ETFs, the SPY, the Qs, the Dow Jones, and IWM. The Qs are up 2%, while the SPY is up about 1%, the Dow is up about 0.6%, and IWM is pretty much flat. It's showing that money is rotating back into tech, and more than anything else into the big FANG stocks, which we'll look at when we cover the NASDAQ. Overall, the FANG stocks also pretty heavily weighted in SPY, so that's part of the reason why SPY is performing as well. And as you can see, we're just breaking out and pushing up to new highs. As I mentioned previously, we've got the 20-day moving average and the 50-day moving average, both kind of coming up in parallel fashion. This is usually a good indicator of a strong trend. And really, the one thing I want to stress here is that despite how we feel about the market, we can't help but not ignore that it just keeps going up. And as long as it keeps doing that, we have to continue taking advantage of this market, because it's not always going to be this easy to trade. And I know some people are going to say, well, it's not that easy to trade. But the truth is that when a market is as strong as it has been for the last almost a year now, since basically March, after the coronavirus sort of mini crash that we had, the market's been just climbing steadily, right? So if we go and take a look at a weekly chart, you take a look at, so obviously this was a pretty ugly start last year around February and March, right? But since then, the market has just been in an almost uninterrupted climb. We've had a couple of periods of consolidation that lasted a month, maybe 2 months, but for the most part, the market's been going just straight up. And this is the type of market that erases a lot of mistakes traders make, and tends to reward traders that just play to the long side, regardless of what types of setups they take or what types of trades they look for. And it's easy to get complacent, and it's easy to get a little bit lax with your discipline when you have a market that's behaving this well, because it erases a lot of your mistakes. And so what we want to do is make sure that we are taking advantage of this bullish nature, but we're not kind of ignoring the normal rules and the normal risk management that we have to put into place when we go ahead and trade. And so that's kind of the key here, is we want to use this market when it's being this beneficial to us, but we don't want to get complacent, we don't want to get lazy and start taking bad trades because the market is going to keep going up. It's not going to keep going up forever. And if we think it is, that's usually when you get punished by it. And what happens a lot of times is traders, they'll say this market's not easy because they're ignoring the risk management rules, and then they get faked out because every now and then you get a distribution candle, you get one big swing, and that stops them out, and then they're saying, well, this market's ridiculous, it's really hard, and it's not. It's actually a pretty easy market as long as you understand what your risk management is and you understand what a good entry on a stock is. You don't want to chase a stock that's up 5-6 days in a row. Sure, it could keep going up, but all it takes is one red candle to stop you out, and then it could turn around and go right back in the other direction. So, for instance, if we look at the S&P 500, we're going to zoom in to the most recent price action. You can see we're consolidating pretty nicely, and then we broke out. And then last week when we were analyzing the market, you'll notice we had a nice little bull flag, right? And so what happened was it actually shook out some traders. We had an attempted breakout that failed, and we came right back down and tested the 20. And for traders that were looking to buy this or looking to try to play to the long side, they got shaken out. And then what happens? Once we have enough weak hands out of the picture, the stronger hands that know to wait for the right value areas, they come in and step in, they support price, and they ride it up to the new highs. And so what they'll be doing now is they'll be taking profits in the next few days, and we'll set up another scenario like this where we get a consolidation range, and then we'll do the whole process over and over again until eventually there will be too many sellers and not enough buyers, and that's when the market starts to correct. And that may happen tomorrow, that might happen next week, it might not happen for another 2 months. We can't really tell, and I know a lot of times people come here for predictions, and we do our best to try to guess what the market wants to do, but in truth, it's up to us. As if you're a swing trader, if you're a short-term trader, you don't really want to predict the market. Sure, you want to have a thesis or a theory in place as to what the market is going to do, but you want to react to what the market does. That way, you're not caught with your pants down when the market does the opposite of what most people are expecting. And so, in this particular case, you can see we had a nice flag. We got a little bit of a shakeout. We tested the 20, and then we broke out. And really, today's the big breakout day. And again, a lot of that has to do with the overnight action. Now, I mentioned this last week, but it's important to keep in mind again. We, especially with Netflix reporting now, we're definitely in earnings season. And if you are a swing trader, you need to be cognizant of whatever the report date or time is for whatever stock you are trading. If you were looking to trade a stock and you don't have any kind of clue as to what it's going to do for earnings, and you're just trading that stock directionally, you're probably better off trying to manage your risk somehow. Now, some people will trade through earnings because it's part of their MO to hold a position for longer than 3 months, and if that's the case, then you're going to have to hold through earnings. But if you're someone that swing trades and tries to hold a stock for a week, maybe 10 days, then you're subjecting yourself to extra risk and extra volatility if you buy a stock the day before earnings. And the truth of the matter is if you're using technical analysis like I do, it's not going to work in the middle of an earnings report. A lot of times you have unknown news that's going to come out during that report, and that's going to affect the equity a lot stronger than some of the short-term technical levels will. Now, in the long term, those technical levels will come into place, as will fundamentals. But in the short term, it's going to be all about the emotion in the marketplace and the sort of knee-jerk reaction to whatever the news is that comes out of that particular earnings report. And so we have to understand that. Now, I personally enjoy trading earnings, but I do it with an approach that's specifically tailored for that. You won't see me recommend a directional swing trade the day before an earnings report. You might see me say, well, we want to go ahead and try to sell or buy volatility on a stock like we did with Netflix yesterday, which actually did not work, but you might see me try to take a trade like that because there is a certain amount of predictability with how a stock reacts during an earnings report, but it's based on probabilities. And if something works 65-70% of the time, then you want to go ahead and try to take that type of a trade. But it's very different from just saying, I want to go long or I want to go short a stock before earnings. Because again, you look at a Netflix. Netflix is up today approximately, like 12-13%? 16% at the moment. And this could have easily been 16% down. And so if you were trying to buy this and it actually was in the other direction, you would be down a big hole. Now, of course, if you were lucky and you guessed correctly, then this is great. But it could be that someone decided they wanted to short Netflix and they'd be down 16% at the moment because, again, maybe they weren't anticipating the earnings report that was coming out last night. So it's important that we keep that in mind and that we understand that our number one goal as a trader is to manage our risk. It's not necessarily to look for profits. The profits kind of come with the trader that does his due diligence and understands what his risk is and is able to control that, because that's really the only thing we can control. I said this last week, but I'll say it again. Trading is more of a game of probabilities than it is absolutes. You could have the most perfect trade setup, and then it fails on you, because it's really based off probability. If a stock works for you, if a move works for you 60-70% of the time, then that gives you an edge. And over the long run, that's going to work well for you. But in one single trade, it could go in the opposite direction. If I gave you a coin that flips heads 60% of the time, then you know that if you take enough bets with that coin, that you're going to win over the long run. But that doesn't mean any particular coin flip you take is going to be right. Sometimes you're just going to be wrong, because there's still some random chance involved in that. So the only thing you could really do as a trader is kind of control what risk you are assuming before the trade takes place, and then from there you let the probabilities kind of take over and take it wherever it might want to take it. So keep that in mind. Now, as far as the SPY is concerned, like I said, we have a new breakout. We're at new highs, and honestly, it looks like it wants to continue ramping up from here over the next day or two. We have a lot of big earnings reports that are going to be coming out in the next week or two, and they will have an impact on the market. And it will be interesting to see once we get to the Amazons and the Apples of the world, and we get to see an idea of just where money was being spent and how it was being spent during last Christmas. We'll get a better idea of what we can expect from our economy in the next 3 months, and where the market is anticipating us going. Obviously, we have a new president being sworn in today, so that might have, again, some impact in the next week or two as we start to kind of settle into a new paradigm, where there might be different ways of managing our economy. But for now, that's still kind of an unknown, and we'll see where that takes us as we move forward over the next couple of weeks. But what we have right now is it's interesting, we have a breakout, and it's pretty bullish in nature. So it's a market that's anticipating good news, or kind of a remaining in the status quo as what we've had the last 4 years as far as economic policies, particularly with printing and with interest rates, and not really expecting bad news coming out of earnings based off of what we saw with Netflix. So as of right now, the market's expecting these things to be positive, and it's rallying in anticipation of them. So we'll see what happens as we move into the next week or two based off of that. So let's take a look at some of the key levels on the S&P 500 and see what we can expect, and at what point can we go ahead and shift our view of the market and decide maybe it's shifting back from bullish to maybe more neutral. So first up, in the very, very short term, we just broke out. I'm going to go ahead and reappropriate this little rectangle that I have already in place. So we just broke out of a very short-term consolidation range, right? So that becomes our short-term support levels. Now, if we head back, this 381 should be support because it just broke out. It was resistance. We had the fake out that came all the way back down here, and then we broke out, right? So usually with those fake outs, these breakouts hold. And if they do hold, then we should expect another day of going up. And then eventually when we do consolidate, this should now act as a floor, right? So as far as expecting the market to be in rally mode, we should hold above 381. Now, that's not necessarily going to happen. And if it doesn't happen, as long as we come back and hold around the 20-day moving average, and worst case scenario, this 374, 375 area, as long as we hold above that, well, the market's still slowly grinding upwards, and it's still stair-stepping upwards, and it's still pretty bullish. If we fall below the 20-day, then that's the first step towards a market that's going to be more neutral. Now, it's not going to be bearish. It's not going to point to a market that's negative. It's just going to point to a market that's probably going to need more time to consolidate and digest whatever's going to happen with earnings season and whatever's going to happen with our new president coming in. And so that could be a situation that would warrant us to be a little bit more cautious. But until SPY or any of the major indices fall below their 20-day, we can assume that it's all systems go for a bull market. Now, if we do head back to the 50, or if we head further back and test this 364 level, these are still very bullish support levels. And they're still going to be good buy the dip opportunities if we come down to that area. It's going to take a lot of damage to these indices before we have a market that is in the threat of topping out or in the threat of rolling over. And so, we've had such a strong rally that at a certain point we will have a sharper correction than what we've seen, but that correction won't be the death knell for this rally or for this bull market. It'll just mean that the market needs more time to consolidate and set up in case it wants to rally again. So these are kind of our tells as far as what we can expect in the very short term. 381 to 375 are the key areas for a short-term rally. If we fall below that and we get to the 50, then we can expect a market that's more neutral, but again, not bearish. And I would still look at it as a buying opportunity as it heads back down to 368 to 364. And at this point, we shouldn't expect price to fall below that. We need a lot more negative news. We need some really ugly earnings before we can expect the price action to fall below that. And I would not expect that, certainly not from here to next Wednesday, and probably not over the next couple of weeks at the very least. Again, we'll get into the FANG stocks in a second, and we'll look at their earnings dates, and that'll give us a better idea of when there could be a catalyst that could shift the price action in the market. But as of right now, the assumption is the market's going to continue rallying. We just started a new breakout today, which likely means another day or two of green action before we get some consolidation. Again, it could fail, but even if it fails, as long as we stay above the 20-day moving average, we're still okay, and we're still kind of holding up in this. If you look at it, we kind of got this little trajectory here where we've got a channel forming, right? And so we could still pull back and stay within this channel and continue slowly climbing upwards. So overall, we're still in a good spot here, and it's not in a market that's in any kind of danger of failing on us here. Now, let's take a look at the NASDAQ. And again, big breakout, right? Look at the nice big move. Now it's a little bit of a hammer candle, which is not that exciting. Some of that was due to some fluctuation earlier in the morning. Let's go ahead and take a look at the 5-minute candle. You can see it was just basically, a little bit of a drop in the morning, but we basically just gone up, right? And so overall, matter of fact, I think some of that is just a wick that's not even really there. Nice breakout. Again, we had a nice consolidation range. We had a little bull flag just like we had on the S&P 500, and we've broken out from it. And this, again, is very bullish in nature. Nothing on here screams negative. Matter of fact, the only thing you could say that's even remotely negative on this is that we are kind of at the top of a channel. Right? So there's the possibility that we kind of grind along the top of that channel, but we've had other indices like IWM kind of break through their channels, and we'll get to that in a minute. So there's always a possibility that we just continue to accelerate and we continue to boost back upward, because even though this is a steady channel, this is not really an overbought market, because as I pointed out with the S&P 500, we've been stair-stepping our way. You can see we have some horizontal levels of support here. So we kind of broke out, then we traded sideways, we broke out, we traded sideways, we broke out, we traded sideways, and now we're breaking out again. Right, so this isn't necessarily a market that's overbought or overextended. It's a market that's just slowly grinding upwards. I'll actually leave this channel like this, at least on the bottom side, for now. We'll kind of continue following and see how it goes. Now, just like the S&P 500, the 20 and the 50-day moving average forming nice train tracks for the price action to continue climbing upwards. And again, it shows a market that's in a strong rally mode and not one that we need to really be worried about. As long as it continues to trade like this, there's no reason for us to not want to trade to the long side. There's no reason not to buy dips. And again, the only real concern we have right now is making sure that we are disciplined and that we don't take trades that are chasing the price action. We've discussed this in the past, this idea of, most people assume that the biggest problem with trading is the fear of loss, the fear of losing money. But in reality, I think the most problematic issue that people have emotionally is the fear of missing out. FOMO, which is kind of a cryptocurrency term that has kind of made its way into the regular markets. And this fear of missing out is something that a lot of traders get into a lot of trouble with, because they'll see a breakout like this and they'll go ahead and they'll try to chase something that's already broken out as well, and is up maybe 5-6%. Maybe they'll chase Netflix, not understanding that it's much better off. You're much better off trying to take a trade on something that's just beginning to break out and is beginning to leave a consolidation range, rather than something that's up 5, 6, 7 days in a row. And that's how you get yourself into trouble, particularly in a bull market like this that just continues to just grind upwards. Like I said before when we were talking about SPY, This market continues to take turns as it rallies, as it rotates back and forth between the small caps and the big tech names, and we want to make sure that we continue to ride those waves as they go back and forth, right? So what are the key levels on the Qs that we need to concern ourselves with? Obviously, the first level would be a return right back into this range that we just broke out of, with a move back below 316 and our 20-day moving average right around 313. This area right here, we'll put a little rectangle here. This is a very strong short-term support level, and this should hold if we want to maintain this bullish price action. If we lose that, we're almost certainly going to head back to the 50. And again, I think that would be more indicative of a market that is going to be neutral and range bound rather than a topping or rolling over process. I think, again, we have a market that's so strong that it's going to take a lot of damage before we could consider it in a state where it's going to top. You know, it could definitely slow down and grind back to a sideways price action and let the moving averages taper off. But for now, as you can see, we haven't had a test of the 50-day since we've broken out during the holiday season. And a lot of times you'll have that. You'll have to come back and test the 50, but you'll eventually, especially the first or second test of the 50, usually resolves upwards as well, right? So in the very short term, this 315 is a critical level, and as long as we're above it, it's basically all systems go, and we're continuing to just climb up during that channel. If we lose that, all right, well then we've got a little bit to worry about, but not a lot, because we still have a good support level around 308, which is probably going to be right around where the 50 is, and that should still be seen as a buy the dip area. And if that fails, then we could probably get a little bit more worried about the market, but even then, there's an even stronger support zone right here, right around the previous highs from in September, right around 300, which is a big fat round number on the Qs, and is a level of what was resistance that has flipped to support and was only really tested once. And so even if we lose all those major levels, I would still expect us to be in a bullish buy the dip scenario when we came back to that level, but with the understanding that it's a market that's more range bound rather than one right now that's playing momentum to the upside. So right now we have a market that's just steadily climbing, so we want to take momentum plays to the upside. If we start to lose some of these levels I just pointed out, we're still in a bull market, but it's a market that's more range bound in nature and one that we need to take advantage of more mean reversion plays rather than just trying to play momentum upwards. All right, and this also is important as far as your profit taking strategies. When you have a market that's climbing like this, you want to trail your stop more. And if we start to break some of these levels, then you want to be quicker about taking profits. When a market's range bound, you want to look at levels that are clear target objectives and try to take your profits in those spots. All right, so let's take a real quick look at some of the FANG stocks before we move on to the Dow. All right, so as you can see, now a lot of these, we're having some trouble and we're slowly dropping. There's a lot of negative sentiment on the FANG stocks, and some of it was based off of the way they treated our Trump as he was being kind of canceled out, and they were kind of dropping. Now, this was actually a good buying opportunity for anyone that wanted to go ahead and try to get long any of these FANG stocks, because again, these stocks, Facebook, Amazon, Apple, Netflix, Google, and to a certain extent Tesla, which is not really a FANG stock but is kind of in that same category, anytime you see a drop in these stocks, whatever the reason is, whatever the news is, whatever your ideological concerns might be regarding them, they are basically printing machines for money. And if there's a stock that you want to be making sure that you're accumulating as they drop, it's going to be one of these five. And you want to make sure that in your long-term holdings, you always accumulate these when they drop and when they come to support areas. Now, sooner or later, they of course have much sharper corrections, but generally speaking, these are the kind of stocks that usually behave well when they come back to support. And so the fact that they were slowly dropping to these levels, they were presenting us with good opportunities. Now, the one issue we have with them right now is what I mentioned at the open, which is we have earnings coming up, right? So you can see Facebook reports earnings in 7 days on the 27th, which is basically next Wednesday, right? So at this point, it's a little difficult to take a swing trade on them. They're also up quite a bit over the last couple of days, and they're moving into these moving averages. But the important thing to note here is money is rotating back into the FANG stocks, and it's interesting because it's rotating right into the earnings. We look at Amazon. Amazon, a nice big day today. See, now this one was actually a pretty nice spot here. We had a nice little wedge that was forming on it, and we had the breakout today. Again, Amazon reports earnings in 13 days, so there's a little bit of time for a bullish play on this because we got about 2 weeks to go. Apple starting to break out from the same sort of wedge as Amazon. It's a very similar chart pattern, and we've got a breakout. And again, it's up 3% today, but it's still well within range of being able to be bought at this point. The problem, again, 7 days till earnings. So again, this is something that you'd have to get rid of by next Wednesday, unless you wanted to go ahead and find a different way of managing your risk. And there are ways of managing risks on trades like this. So for instance, you could take a long trade on this, and if you get a couple of days of nice action, you can always substitute it and turn it into a call play if you're comfortable with options, and book some profits that way, or you could just close it out, or maybe even just hold a few shares. But there are ways of managing your risk, but it's important to understand you have a certain window of opportunity before you expose yourself to extra volatility that you may not be able to predict. So obviously Apple's up. Obviously Netflix with earnings yesterday is up. We looked at them earlier. They're up 15-16% today. Huge move upwards. You can see this white rectangle, by the way, that I had in place was what the options were pricing in as far as an expected move. And as you can see, it blew well past that, as Netflix does every now and then. It's a name that can move 15-20% quite often, and making it kind of an explosive earnings trade. And so far doing really strongly today and breaking out not only past its current expected range, but also if we kind of zoom out here, you take a look at what it's doing, it's challenging some important all-time highs here as it's breaking out, and kind of trying to leave behind a major range that it's been stuck in since July of last year. So a huge move on Netflix as it tries to break out and establish a new range. And again, this is part of the reason why the market's breaking out. And then finally, the last FANG stock is Google, which again, huge breakout on it. They report in about 2 weeks as well, just like Apple. So a lot of these FANG stocks report in the next couple of weeks. We have 2 of them on Wednesday of next week, then we have 2 of them again, I think about Tuesday of the following week. So a lot of that is going to be an impact on the market. Now, interestingly enough, they're running up into their earnings. We'll see whether that becomes a sell the news event or whether they continue through that, or what's going to happen. But it's important to keep in mind the kind of impact we're seeing here. And like I said, one of the keys that we want to see here is money's rotating back into them after they kind of stagnated, as money was rotating into IWM and some of the small caps. There's this relationship that we've been following throughout the last year in which in 2020 these tech stocks all benefited from our reactions to the coronavirus and COVID-19. Most of these benefit from us working at home, shopping from home. Basically, all of our consumer activities are now based from the house. And all of these companies benefited from that. Meanwhile, a lot of the small caps, a lot of the energy names that you'll find in IWM have not done well, right? And so recently, with a vaccine finally coming out, with us trying to open up the economy, those names have started to produce a little bit better, and they took a little bit of capital away from the tech sector and away from these names that have benefited from it. And over the last month or two, we've seen kind of a volleyball action here, tennis, where they just keep going back and forth between the small caps and the big tech names, small caps, big tech, as money rotates back and forth as the markets just sort of stair steps up, right? And so it's important to realize that right now money's flowing back into these tech stocks. Now, interestingly enough, Tesla has not really broken out along with these. Now, there's a difference here. Those other 5 were underperforming over the last month, and Tesla has been screaming higher throughout the holiday season. So it's not really in the same spot where it needed to kind of catch up to the markets. However, it is in a very tight range, and also reports earnings in another week. So it's another one that looks pretty good here for someone that wants to play momentum, but with the understanding that they only have a window of 1 week before it reports earnings, at which point we get a lot of extra volatility that could skew the trade one way or the other that you may not be ready for. So again, those are important considerations if you're looking at tech stocks right now, is understanding that they all have earnings coming up in the next couple of weeks, and that could place an extra window on your trade that you may not be ready for, or make it to the point where you don't have enough time for a trade to work in your favor if you don't catch the timing just right. So keep that in mind. Now let's take a look again real quick at the Qs. We already went over the levels. So as long as it holds in this channel, we can expect all systems go for a rally. If we fall back into the 50, again, I think it's still a bull market, but it's one in which we need to be a little bit more neutral and understand that there's going to be more range-based trading we need to take. If we fall below that, that's when we start to worry a little bit more about the market. But long-term, it's still a very strong bull market, but in the short to intermediate term, we have to prepare for a market that might be a little bit more sluggish and might need to spend more time correcting, even if it's sideways and not necessarily down. Now, everything we said about the SPY and the NASDAQ, it kind of takes place and confirms with the SPY and with the Dow Jones. Now, the one difference, again, the Dow is lagging a bit today compared to the S&P 500 and the NASDAQ. You can see it hasn't broken out to new highs, but it's doing the same sort of thing. It's kind of breaking out, and you'll notice the channel that it's in, it already broke out above it, right? So to a certain extent, it's actually ahead of the SPY and the NASDAQ in that regard. While the S&P 500 and the NASDAQ were kind of sluggishly trading sideways, the Dow Jones and IWM were climbing steadily last week. And so you'll see they broke out of that of that rising channel last week. And so even though they're not really in the same place today with regards to all-time highs, they're still in a good spot, especially when you compare to the previous channel that they were kind of navigating. And so overall, this is still pretty bullish price action. You just need another extension tomorrow in order for the Dow Jones to participate and start pushing to new all-time highs. Again, when this is the bad chart of the four indices, it shows a market that's very strong, right? Again, over the 20, over the 50, they're both climbing steadily upwards. We have a channel that we're kind of pushing through. We have a consolidation range that we are about to break out of. So overall, it's a bull market, and it's a strong bull market, and it's not one that we need to be too concerned about. Now, I will note, like I said before, I do have a lot of names in my watch list that aren't performing quite as well as this. But again, I think that's more to do with rotation back and forth through sectors and the fact that I tend to look at more tech stocks than I do some of the more industrial names and some of the energy names that have done poorly throughout 2020. But things are perking up, and as long as these indices continue to stair-step upwards, we can assume that money is rotating back and forth. And like I said, right now it's in tech. It might be that way for another few days. It might be that way until next Wednesday. But sooner or later it'll shift back to the other areas, and we just have to be cognizant of that and make sure that we continue, like I said, riding these waves back and forth. And I'll show you in a minute how you can go ahead and take a look at what areas are strong in the market and how you want to go ahead and take advantage of that momentum. Now, key levels on the Dow, for the most part, we have a very short-term support level around 308. But I think the key areas here are really the moving averages. We've got the 20-day moving average, which has supported price action throughout December and the start of this year. And until that breaks, we can assume it's going to hold. And if it does, well, we've got this rising trend line, and we've got the 50-day, which again should support price if it comes back down into this 304, 305 area. And you know, the moving average will come up and meet it right around there. And as long as we don't lose that, again, we're still in a market that's climbing steadily and not one that we need to worry about. If we do lose that, well, we've got a lot of horizontal support, and really the major levels all the way down here, 291 to 292. We likely don't get there, at least not in the next few weeks. Again, if there are very poor earnings next Wednesday and then on the following week with the big FANG stocks, then maybe we start to challenge these prices. But over the next week or two, if we do start to break down, we have a lot of support here. Again, we've got 304 as support, and we've got 300 as support, and those areas should be able to sustain price action if we do come down to that area. All right, finally we've got IWM, and again, IWM is so strong that that channel is too vertical to even really concern ourselves with. You can see we did print new all-time highs. The candle's not that great today. It's the one candle that, again, it almost looks like it's ready to kind of tip over. We've got a rising wedge, which is usually not the kind of consolidation range that you normally want to take advantage of. But again, until this breaks, we're in a market that's climbing upward steadily. And the issue we have now is if IWM does pull back, it could be because money continues to rotate into the Qs and into SPY. So, at this point, even if we see a couple red candles, it's not really going to ding the market because, again, the money is starting to rotate towards the other areas of the market that are slowing down or were slowing down and maybe are now going to speed up a bit. So it wouldn't be the worst thing in the world to see a red candle here and to come back and test the 20, at which point maybe money rotates back into some of the small caps and we continue that cycle of going back and forth between the energy names and the names that are starting to recover versus the tech names that have already been doing well throughout the last year or so. Now, one thing I always point out, IWM is a proxy for risk, right? It's the index that has the most volatile assets. It has the riskiest assets. When it's outperforming like this, it shows a market and it shows an environment where traders are willing to assume risk and they are pretty much not in fear of losing money. Until this changes, we can again assume that we're in a very strong rally and a market that wants to go upwards, right? So if we start to see IWM correct, sharply past the 20 and into the 50, and we see the Dow Jones hold up and we see maybe the S&P 500 hold up, then that could be indicative of a market that's starting to get a little bit more fearful and wants to assume a little bit less risk. But until we see that, we shouldn't really change our approach to trading. And like I said, I've been a little bit leery of the market since the turn of the year. That's something that I pointed out, especially on January 4th, which is our first Wednesday market stream. And I was expecting a market that might be more range-bound or a little bit less conducive to strong rallies like we've seen. But, personal feelings aside, it's the price action that pays. And so I'm still, even though I've been a little fearful of the market, I've still been trading to the long side and still taking my normal trades because that's what the market's presenting with us. So keep that in mind, regardless of what you're feeling with the market right now. Until it shows its hand and until it starts to change in character, we have to assume that it wants to continue rallying. And like I said, we've looked at key levels across all of the major indices now, and those are the points that we worry about. If we start to lose those levels, that's the market tipping its hand. That's the market giving us a hint that it's ready to shift in nature and that we're going to get into a different type of price environment. So until we see that, we don't have to worry too much about it, okay? It's very rare, like I said, so these moves like we had in March, these kind of black swan events, they're usually very rare. And when they do happen, you'll know they're happening because there's a big news event that's kind of a catalyst for it. It's usually something that comes out of nowhere. And so as long as that doesn't happen, we're not normally going to just top in one day and have a market that just craters all the way through and crashes. Even when markets crash, they have a lot of shifts in direction where we start to have opportunities to go ahead and rebalance our portfolios or change our stance or change our perspective on how we want to go ahead and trade. So at the moment, there's no warning here telling us that the market is ready to top out or the market is even ready to shift to neutral. So we have to continue, like I said, just playing to the long side and taking advantage of what we can. So the key levels on IWM, really it's the 20-day moving average. We have a level here right around 205, which is where we sort of started to break out. And then we had a couple of days of kind of transitioning before we really started to climb upwards. But below that, we've got 200, right? 199 to 200. I imagine if we come down to that, the 50-day will come up and meet price, and that should be a really good buying opportunity, assuming we're not in the middle of a bigger shift in market direction. And we're likely to see buyers step up in that area. Beyond that, we're so far away from our previous range that there's a long way to go before we have to worry about a market that has lost the significant portion of this rally that we've sort of just experienced since November. So like I said, strong bull market, and there's a lot of room to go down. Now, there's a lot of room to go down and still be in a bull market. So the important thing to keep in mind, like I said, is discipline. Just because we're in a bull market, just because it's strong, doesn't mean you should ignore your stops. Doesn't mean that you should use poor risk management, because any trader could be wiped out from a move from 214 down to the 190s or 170s, and you'll have your account wiped out, and it could still be in a bull market. It could turn around and rally right from there and keep climbing upwards, and you'll just have been kind of erased because the market decided to pull back at a certain point. So just because we're in a bull market doesn't mean you should ignore any of your normal risk reward management. All right, so that's the four indices. Those of you that are in here, if you have any question regarding this or regarding the way I'm approaching trading, you can add it into the chat, and I'll be more than happy to go ahead and discuss with you my thoughts on that. You also, if you have a chart request or a chart you want me to look at, feel free to add it into the chat as well. We're going to look real quick at the US dollar. We're going to look at oil, gold, silver, and at this point we're also going to look at Bitcoin. I think that's become an important commodity to look at as well. And then we'll move on, like I said, to any chart requests. If those of you who are in here have a chart that you have a question on. It could be a trade. It could be a trade that you're looking to take. It could be one you're in. Or it could even just be a question on a pattern or, anything any kind of technical analysis question you might have. Now, if you look at the UUP index, which is the US dollars in aggregate, you'll notice that we are finally seeing some slightly bullish price action on the dollar. It's nothing impressive, but what it's doing is it's stabilizing, right? We've had a dollar that's been in a free fall since November, which not coincidentally is a market that's been rallying strongly because again it's priced in US dollars, right? And a lot of things that are priced in US dollar like oil and Bitcoin have been rallying strongly along with this free fall in the US dollar. Now the US dollar is finally starting to stabilize, and over the last 3 days you can see it's actually kind of up a little bit, showing that it's trying to at least shift into neutral instead of just going down the whole time. It's not out of the woods. There's still a lot of potential for us to keep heading south, but for the moment it's sort of stabilizing. And if we look at the euro US dollar, which of course is the inverse picture of that, you'll notice that the euro was doing really well, and then recently with the dollar starting to stabilize, the euro has pulled back a bit. And this is actually some of the price action that I was pointing out with the market indices, where you have a strong 20-day moving average, and eventually when you do break it, you always come back, not always, but for the most part, you usually come back and test the 50, and you usually find support there. Now, typically in this case, it's going to come up and test the 20 again, and from there, it'll eventually resolve on one side or the other of these moving averages. More often than not, when you have a strong breakout, it usually resolves in the prior direction, which means it should be able to break past the 20 and start coming right back up. If that's the case, we'll see the US dollar obviously weaken again and start to struggle. If it's not the case, if the US dollar continues to gain strength, well then we're going to see a rollover here. We're going to see the 20 cross the 50, and we'll see the euro continue to trade sideways and come back down and retest this breakout zone around 119 or possibly 120 as it continues to kind of move forward. So at the moment, it's actually a positive for the dollar, but there's a chance that it's going to kind of return back to where it was before, unless it can continue to build upon this little breakout or this little bounce that it's had recently. If we look at the US versus the Canadian, we'll see a sort of a different picture here. And this is, again, this particular trade, the US Canadian, is inversely correlated to oil. And oil has been doing well over the last couple of months. So there's a little bit more impact here, and that's part of the reason why the U.S. is struggling versus the Canadian. But as you can see, the U.S. dollar versus the Canadian, it's not really done dropping yet. It's still struggling to try to maintain a new floor here, and at the moment it's really not really holding up very well. So this does not bode well for the U.S. dollar, and actually bodes well for oil once we get into it in a second. And then finally, the last one I want to look at is the U.S. yen. And in this particular case, again, the U.S. dollar, just like it is with the euro, it kind of stabilized, and it's trying to build up some momentum to break a long-term downtrend. And this has been downtrending for a while now. Alright, so with that in mind, if we look at gold and silver, strangely enough, they're not really doing that well considering the dollar has been weak. And surprisingly, with the dollar bouncing over the last couple of days, gold and silver have bounced with it, which is even more odd. Happens every now and then that they move together. They're not 100% inversely correlated, but something that's important to keep in mind. Overall, I'm not interested in gold or silver at the moment. Like I said last week, and basically I've been saying for quite a while now, I am much more interested in playing Bitcoin and some of these other cryptocurrencies as an inverse dollar play right now compared to gold and silver. I think gold and silver, they've been doing something kind of odd here. As silver, to a certain extent, a little bit better than gold. But when you consider the weakness that we saw in the U.S. dollar chart, gold should be trading at newer highs, and it's not. It's been range bound. It's been range bound since August, and it's still kind of stuck in neutral, and it's kind of fluctuating back and forth. Overall, silver in particular here is between 20 and about 27, 28. and it's just kind of going back and forth between them. And like I said, GLD is doing the same thing, and at the moment, I'm not that interested in either one of them as a particular trade. I think there are much better trading opportunities in other areas of either the market or, like I said, cryptocurrencies for those that are capable of trading them. Now, on the other hand, if you look at oil, you look at energy, very strong, continues to climb. It's challenging a pretty key area here around 53, 54. This is something we pointed out last week when it was having this rising channel. It was eventually going to find a ceiling. I don't think we're ready for oil to really hit the 60s, 70s, and beyond. And in my anticipation, this area around 53, 54, 55 should be a ceiling for the current price action. And at that point, we should come back and test the moving averages and maybe come back and backtrack and establish a new range. So we were ranging pretty steadily between about 35 and 44, 43. And at this point, we need to establish a new sideways range on oil. And what we're doing right now is trying to figure out exactly where the ceiling is. And once we figure out the ceiling, then we can come back and start figuring out where the floor is. And so that's what oil's doing right now. Like I said, energy has been very strong. If you come over here to Finviz, and you go ahead and you go to the maps. Actually, we're not even going to go to the map. We're going to go to groups. You can take a look at what's doing well today, what's doing well over the last week, what's doing well over the last month, and over the last 3 months. And you can see, especially over the last 3 months, energy over the last month, basic materials, they've been doing incredibly well. Now, recently they pulled back a bit. Energy only 0.2, energy 0.1. And that's because money, like I said, is starting to rotate into other areas of the market. And this is something that you need to keep in mind. Like I said before, when you're looking at riding these waves back and forth. So notice all of a sudden what's happening here. Communication, real estate, consumer cyclical. Real estate, communication, consumer cyclical. Over here, consumer cyclical was starting to pick up some steam. Real estate was kind of slow. Real estate was down here. So you're noticing we're getting a rotation and energy starting to slow down, right? So that's what you need to be cognizant of. That's what you want to pay attention to. From there, you can go to your screener and you could go in and you could figure out where you want to look at. You can go to the industry, or you can go to the sector, and you can start looking for different areas, real estate or whatever it is, and start looking for areas of the market that are going to match what you just saw with the groups. And then you can go ahead and screen it however you want, whether you're looking for the volume, a certain price, whatever it is. There's all kinds of stuff in here that you could go ahead and try to weed out a lot of names. There's obviously 275 real estate names. And then if you look at consumer cyclical, you're going to have another 500 names. So you're going to have to weed them out little by little and figure out what you want. But that's how you go ahead and try to figure out where the money's rotating back and forth and what areas of the market you want to focus on as you start to pick up these trends. Now, a one-day relative performance isn't that important. But as you start to pick up these trends throughout the time frames, that's when you start to figure out where money's starting to rotate. So when you see something here for one day, it's not that important, but a week later when it's there and you still see it on the one day, that's when you start to really figure out where money's rotating. And from there you can start looking at different stocks in those areas to go ahead and try to take advantage of that momentum. Okay, so that's how you go ahead and like I said earlier when we were looking at the market indices, how you try to figure out where money's rotating. Like I said, energy has been strong, but as you can see, as it starts to approach the ceiling here for oil around 53, 54, 55, energy started to slow down. Now that doesn't mean again that it's a top for energy. It just means that energy needs to come, it's exploring where the ceiling is for its current range, and then it's going to come down, figure out where the floor is, and at that point it becomes a good buy again. Okay, now the last pseudo commodity we're going to look at is we're going to look at Bitcoin. And again, I know not everybody here trades this, and some people don't even really believe in it. Like I've said a million times, if you understand technical analysis, you could trade a stock, you could trade a forex currency pair, you could trade a cryptocurrency, you could trade anything that you could chart. So this is an important skill for us to have, is to understand technical analysis. And if we do understand, you're not really trading the instrument. You're not trading Bitcoin. You're not trading Netflix. You're not trading the euro, US dollar. You're trading human psychology. You're trading people's perception of a chart. So when you look at this chart of Bitcoin, this is not a chart of the Bitcoin commodity. This is a picture of what people consider to be the value of the Bitcoin commodity. You might consider it to be worthless. You might think it's just a stupid computer program that people are foolishly placing value in. But that's not the key. The key here is that people put value in it, and as long as they do, you can trade it. You may not want to invest in it if you don't believe in it, but that doesn't mean you can't trade it. And as long as you can trade it, then you can go ahead and try to take advantage of these wild price fluctuations that occur not just in Bitcoin, but in a lot of different cryptocurrencies. So we look at Bitcoin, you can see it's in the middle of a nice consolidation range. And it's trading in a pretty nice little triangle. And we should get some nice momentum on it pretty soon. Now, again, this is not the only major cryptocurrency. There's obviously Ethereum as well. And Ethereum has been in a very, very big breakout. And again, it also had a nice consolidation range that it just broke out from. Right? And so you can see that it's pretty bullish in nature. Now, you know, again, keep in mind, this thing in December was trading around $500-600, and it was up to $1,300-1,400 just 2 days ago. So you can get some pretty explosive moves on these things if you are capable of trading them. Again, Litecoin, which is sort of the forgotten one of the three, again, still doubled in price, almost tripled in price, really, if you look at it from November. And not quite the same pattern. This isn't quite as an easy a pattern to trade right now, so it's one that I probably wouldn't focus on too much. But even in this particular case, we do have an interesting thing here. Now this is really more of a zone like that, which makes it a little bit more difficult to trade. And I'd probably focus more on Bitcoin over this. But if you can look at these charts and you can analyze the price action, you can go ahead and try to figure out a good trading strategy to go ahead and try to take advantage of some of these. You know, for those of you that are into lesser known coins, there are other types of coins that we could look at. You know, if you look over here, I do follow quite a few of them. And there are more in there that I just trade off of memory rather than putting them on my watch list. But there are other cryptocurrencies that you could follow. And like I said before, they're an equity just like a stock. And if you have an account, whether it be in Coinbase or Binance or whatever other exchange you can have access to, you can go ahead and flip these back and forth just like stocks. And you can go ahead and make plenty of money with them, just like you could with the stock market. And again, they provide a lot of exceptional volatility, which of course lends risk, but also gives you more reward. So keep that in mind. This is another tool that's important for us to have if we are trying to make our way as traders, because sometimes the market doesn't cooperate. Sometimes the crypto markets don't cooperate. They were terrible throughout all of 2019 and even most of 2020, but the market was great. And so you want to make sure that you understand the fluctuations. I know a lot of times when I go into Forex and I go into the Euro US dollar, a lot of people kind of like their eyes glaze over because it's like, oh, whatever, it's just Forex. But the truth is, you can make money with any of these. And a lot of times when you have a market, so right now we have a market that's fantastic and it's providing us with a lot of opportunities, but there are times when the market becomes kind of heavy or kind of starts chopping around. It doesn't give you good trading opportunities. But if you're comfortable with technical analysis, you can move off and start trading different types of markets. You could trade the Forex pairs, and they'll often give you good opportunities when the market does not. And it's the same with these cryptocurrencies. So, broaden your horizons. I'm not saying you need to marry yourself to these, but it's an area that you should be exploring if you are someone that's serious about trading and wants to improve their performance over the next year or so. All right, so that's all I have to cover. If anyone has a chart they want me to look at, feel free to type it in. If not, we could wrap it up for today. So just let me know. You can type it in the chat. And if anybody's kind of shy and doesn't really want to put it on here, you can always message me on Twitter. Or you can find us on our Discord and you can put it on there. And I'll be more than happy to give you guys, my analysis of these charts in whatever medium you prefer. But for those of you that are on here, if you have a question, feel free to type it into the chat if you can find the chat. I know some people struggle with that. And I'll be more than happy to help out. If not, we can call it a day, and we'll see each other next Wednesday. All right, so we'll wrap it up here. Seems like no one has any questions. Like I said, you can always find me on Twitter at StockDarts, and I'll be more than happy to answer your questions on there as well. Also, if you're looking for more content from me, you can always visit me at patreon.com/StockDarts, where I'm more than happy to give you, we have a lot of blog posts on there. Some of it is under subscription, but most of it is either free or becomes free after a while. So you can always go back and take a look at my trading styles. All right, we'll win. Is that you, Ray? Can't remember if that was your name on here. You want to look at SNSS. Good to see you, Ray. It's been a while. Hope you're having a good start to the year. All right, so my first question for you will be, is this something you were already in? Because if you're not in this, this is the epitome of what a chasing a stock would be. If you were trying to get involved here, you have an order to go long at 3-4. So this right here to me is the perfect example of chasing price action. We have a stock that was trading at $2 at the start of the year, and it's up to $3.50, and we've got this shooting star, which is more often than not a resistance candle or a topping candle. Let's go to the weekly real quick and take a look at what it's doing compared to what it's done in the past, right? So we have a couple things we want to look at. I'm going to zoom out. We have a stock that's in a major downtrend. It's been in a downtrend for a long, long time, right? If we draw, we connect these. It's not there yet, so at least you have that going for you. All right, so now the next thing is we want to identify a key level here. Now this is actually a positive in that it's still holding above this key area, but we've got another key area. See, this is a problem. This one's a little messy, right? So we've got this band of price action, which is not significant. The more significant price action is right around 298 to 3, right? But if we look at this in the long term, and actually there's another level up here around 6, but we're not worried about that right now. We look at this in the long term, we see what it did, right? So it was trying to hold, and it held around 3, held at 3, then failed. And when it failed, it went all the way down to almost $1. Now, it's made a run since November of last year, right? So we're talking about 3-4 months now. It's gone from $1 all the way back up to 3, and it actually broke above 3, which is pretty nice. That's actually a very nice breakout. However, think to yourself, what is your risk reward opportunity here on a stock that's just gone from 1 to 3? You think it's going to double again and keep going up to 5 or 6? So that's the one. So the issue I have right now, let's go back to the daily. What we have here, so you have an entry at, what is it, at 314. So you want to buy it as it comes back into this area. And my issue is this could be a good buying opportunity. But if you're just going to buy it as soon as it tags 314, there's always the chance that it comes back down and breaks back below that level and needs to come back and test the 200-day and the 20-day. So I don't really have an issue with your $3.14 target, although I'm not sure where you pulled that out of. I guess it's the high from yesterday. In my mind, you're better off trying to buy it as it approaches 3, but it needs to actually establish support there. So I would like to see it form like a bull flag or something, and trade back, and then maybe hold in that area and prove that it's ready to kind of sustain price above 3, and then continue upwards. So when you're buying this off of today's candle, if it comes back to 314, think about it. Look, it went from 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 candles, right? So the last almost 3 weeks now of trading price action, we've got 2 red candles, right? This is a stock that's ready to correct. It's a stock that's ready for people to take profits on. So I would not buy this just because it comes down to 314 now. Could I be wrong? Could it go to 314, turn around and head right back up and continue upwards? Possibly. But I don't think that my probability of success is very good trying to buy the first time it comes down and tags 314 or tags yesterday's highs. This looks like a stock that's ready to take a break and ready to take a breather. And so if I wanted to trade this, my first thought process is, oh, I missed the trade. You know, because obviously you're trading. If you're trading this, you missed the breakout at $2. You also missed some of these momentum plays as it continued to flag and break out. So what you're looking at now is you had one flag breakout, another flag breakout, another flag breakout, and then now it's got this shooting star. If you want to trade this, wait for the flag and then play the breakout. Don't just buy it on what looks to be a little bit of a blow off top as it continues to accelerate into heavier resistance. Okay, so I personally would hold off on this, Ray. I think at this point to buy this at 314 is chasing price action, and I think these are the kind of situations that get traders into trouble, because it would be normal for this to come back and test 3. It would be normal for it to come back and test 270, and at that point you would be shaken out of your trade, or you would marry it and you'd be down quite a bit, and then it'd have to rally to get right back to your break-even point. At that point, you'd probably panic and close it, and then that's when it's ready to rally and break past that. So the issue I have here is not necessarily with the stock, it's with the timing of your play and with the way you structure it. You're putting yourself in a position where this thing has been up, 12 out of 14 days, and now's when you want to go long. Stocks normally ebb and flow. There's going to be back and forth, and you want to, I'm not saying you want to buy when it's 12 red candles out of 14 days, but you want to have, these guys that have all been long need to take profits, and you need new buyers to step in, and the buyers that are stepping in now are the ones that are chasing price action that are weaker, and they're the ones that are going to abandon the stock and are going to be the ones to drive it back down in the first place. So, it could go up from here, but that doesn't make it a good trade. In my mind, for it to be a good trade, you need to manufacture better risk reward, and the best way to do that would be for it to, if you wanted to buy it around 314, you'd probably want it to kind of stabilize and trade down, and in that way, once it does break back out, you have the timing in your favor rather than right now where the timing is not in your favor, because like I said, it's already moved without you, and it probably needs to take a break. Now, it might not take a break, it might continue going up, but that doesn't necessarily mean that it would have been a good trade, because again, you're not putting yourself in a position to succeed because the risk reward's not really in your favor and the timing's not really in your favor. Okay? But good to hear from you, Ray, and hopefully your year is starting off okay, and hopefully you had a good finish to last year. But glad to see you back in here. Hopefully we'll see you again next week. Again, those of you that are in here, thank you for attending. Glad to see you guys in here. Good to see a couple new viewers. We'll meet again next Wednesday at the same time. And until then, have a good rest of this week.